Welcome to this FRM tutorial on arbitrage pricing theory and multi-factor models of risk and return. In this session, we will move carefully from the intuition behind APT to its formal equations, then to multi-factor return estimation, hedging applications, and finally the Fama-French three-factor model. The goal is not just to memorize definitions, but to understand how these models work, why they matter in practice, and how they are tested in the FRM exam context. As you go through this tutorial, keep one critical question in mind. How does risk determine expected return? Capital Asset Pricing Model, CAPM, gives one answer by focusing only on market risk. Arbitrage Pricing Theory, APT, on the other hand, gives a broader and often more realistic answer by allowing several systematic risk factors to influence returns. That shift from one-factor thinking to multi-factor thinking is one of the most important conceptual transitions in this reading. Let's proceed. By the end of this video, you should be able to do 6 things with confidence. First, explain what arbitrage pricing theory is and state its assumptions with clear understanding. Second, compare arbitrage pricing theory APT with capital asset pricing model CAPM in a precise way. Third, identify the inputs required in a multi-factor model, especially factor betas and factor surprises. Fourth, calculate expected or model implied return using both single factor and multi-factor settings. Fifth, explain how hedging multiple factor exposures work. And sixth, describe and apply the Fama-French three-factor model. For the FRM exam, these learning outcomes are not isolated pieces. Instead, GARP often tests the topic by combining intuition and calculation in the same question. A problem may begin conceptually asking you to distinguish APT from CAPM and then immediately move into a numerical example involving factor shocks or a Fama-French expected return estimate. So while listening to this tutorial, always connect the theory to its exam application. Remember, it's very rare to have long and time-consuming questions or calculations in the actual exam. Understanding the concept and intuition of these topics help you to solve apparently complex questions in a few minutes or even without calculation. So understanding the concept is very foundational for the exam setting. Let's begin with the most testable parts of the topic. The first is CAPM versus APT. You must know not just the CAPM has one factor and APT has many, but also why that difference matters. The second is the meaning of factor betas. A factor beta tells you how sensitive an asset is to a particular systematic factor. The third is single factor versus multi-factor calculations, where you compute predicted return changes from factor surprises. The fourth is hedging factor exposures, especially the idea that neutralizing one factor may unintentionally create exposure to another. And the fifth is interpretation of the Fama-French model. A very common exam trap is to confuse systematic risk with idiosyncratic risk. Multi-factor models explain returns through common drivers such as GDP growth, inflation, or size and value effects, but they do not explain everything. The unexplained component remains in the error term, and that residual risk is idiosyncratic. In APT, that idiosyncratic part is assumed to be diversifiable in a well-diversified portfolio. So if the exam asks whether multi-factor models eliminate all risks, the answer is no. They provide a richer explanation of systematic return drivers, but they do not remove residual firm-specific uncertainty. This reading matters because it addresses one of the core questions in finance. What risks are investors actually paid for bearing? CAPM gives a very elegant answer. Investors are compensated only for exposures to market portfolio, but real-world portfolios rarely depend on just one systematic force. They are exposed to changes in interest rates, inflation, economic growth, credit conditions, sector dynamics, and style effects such as size or value. APT and multi-factor models are important because they recognize that reality. Instead of forcing everything into one market beta, they allow expected return to reflect multiple common drivers. That makes them useful both for return explanation and for risk management. A portfolio manager can identify which factors matter most, estimate exposure, and then hedge or rebalance accordingly. So this topic sits at the intersection of asset pricing and applied risk management. That is exactly why it is so relevant for FRM candidates. Before going deeper into APT, let's quickly revisit CAPM. CAPM is a single factor asset pricing model. It states that the expected return on an asset is the risk-free rate plus compensation for market risk. In compact form, expected RI is equal to RF plus beta I times expected RM minus RF plus EI. Here, RF is the risk-free rate, BIM is the market beta of asset I, RPM is the market risk premium, and EI is the idiosyncratic error term. The intuition is straightforward. If an asset is more sensitive to market movements, meaning that it has a higher beta, investors require a higher expected return. CAPM is attractive because it is simple, elegant, and easy to interpret, but that simplicity is also its limitation. It assumes that only one systematic source of risk matters for expected return. In practice, that is often too restrictive. A bank stock, for example, may be sensitive not only to market movements, but also to interest rate shocks, credit spreads, and regulatory conditions. CAPM compresses all of that into one beta, while APT allows us to model these exposures separately. Arbitrage pricing theory, usually called APT, was proposed by Stephen Ross as an alternative to CAPM, and its main idea is that expected return is driven by multiple systematic factors rather than only the market portfolio. An important strength of APT is its flexibility. The theory does not specify a fixed set of factors. Instead, the analyst chooses relevant factors based on economic reasoning and empirical evidence. Those factors could be macroeconomic variables such as inflation or GDP growth, or they could come from other systematic sources such as size, value, or sector performance. But this flexibility comes with a trade-off, because the theory does not tell you exactly which factors to use. Model selection risk appears. Different analysts may choose different factors, and therefore the quality of the model depends heavily on whether the chosen factors truly capture common risks or not. The core intuition behind APT is an arbitrage argument. That is, if two well-diversified portfolios have the same factor exposures but different expected returns, one portfolio is mispriced relative to another one. In this case, arbitrageurs would buy the mispriced portfolio and sell the overpriced one. In equilibrium, such pricing discrepancies should not persist. Now, let's review the assumptions of APT. These assumptions are important because FRM questions often test them directly. First, asset returns can be explained by systematic factors. In other words, common economic forces influence the returns of money securities at the same time. Second, idiosyncratic risks can be diversified away. This is critical. APT works most naturally in the context of well-diversified portfolios where firm-specific noises become negligible. Third, There are no persistent arbitrage opportunities among well-diversified portfolios. If two diversified portfolios have identical factor exposures but different expected returns, arbitrage should eliminate that mismatch. Fourth, investors seek to maximize profits. And fifth, markets are frictionless, meaning transaction costs, taxes, and short sale restrictions do not materially prevent arbitrage. Here is an important FRM clarification. CAPM usually relies on more restrictive assumptions about investor behavior, market equilibrium, and the efficiency of the market portfolio. APT is less demanding in that sense. Its foundation is primarily a non-arbitrage argument rather than a full equilibrium model of investor choice. We now come to the central APT return equation. The realized return on security I can be written as the one given here. We see that the actual return Ri is composed of the expected return Ei and surprises from other systematic factors. Beta I from 1 all the way to k represents the fraction of other variable surprises that cannot be diversified away due to the systematic nature. That is, Bik is the sensitivity of asset I to the factor k. Any firm-specific or idiosyncratic factors are packed into the error term here. This equation says that realized return differs from expected return when factor surprises occur. Suppose GDP growth turns out to be lower than the expected level. If a stock has a positive GDP beta, that negative GDP surprises will reduce its realized return relative to its expected return. If the beta were negative, the same surprise could have a positive effect. This is a very important exam point. This equation is about realized return and factor surprises. It's not the same as the expected return relation with factors risk premia. Students often mix up the two forms and the exam. Now let's turn to the non-arbitrage expected return relation for a well-diversified portfolio. In this presentation here, expected return of a well-diversified portfolio is composed of expected return of 0 beta portfolio and the risk premium over any factor that has a risk greater than the beta of portfolio. This equation is conceptually different from the previous one. Here we are not using factor surprises. We are expressing expected return as a baseline return plus compensation for exposure to price factors. ERP is the expected return of a well-diversified portfolio. ERZ is the expected return of the 0 beta portfolio, interpreted here as analogous to the risk-free rate. Beta PK here is the portfolio loading on factor K, and expected IK minus ERZ is the risk premium associated with factor K. The intuition is simple. Investors should earn higher expected return when they bear greater exposure to factors that command positive risk premia. So if a factor is positively priced and a portfolio has a higher beta with respect to the factor, the portfolio should offer a higher expected return. For the exam, distinguish clearly between the two APT equations. The realized return equation uses actual minus expected factor outcomes. The expected return equation uses only factor risk premia. So this point is very important to remember. We now compare the APT versus CAPM. This comparison is essential because it summarizes the conceptual difference between the two frameworks. CAPM, or Capital Asset Pricing Model, uses one factor, that is the market portfolio. APT, on the other hand, allows multiple factors. CAPM measures systematic risk using market beta, whereas APT uses factor betas. In CAPM, the relevant factor is prescribed by theory. However, in APT, the factors are not specified in advance, whether they are chosen empirically or economically. CAPM also relies on stronger assumptions, while APT is more flexible and centered on no arbitrage context. The key takeaway is that CAPM can be viewed as a special case of APT with just one factor. This is a very useful way to remember the relationship between the two theories. For the FRM exam, if you see a question asking which model is more flexible, the answer is APT. If the question asks which model is more parsimonious and theoretically elegant, CAPM is usually the intended answer. So remember these points for your exam. In practice, factor models can be grouped into three broad categories. The first category is macroeconomic factor models. These models use broad economic variables such as term spread, inflation, industrial production, or credit spreads. The idea is that macroeconomic shocks affect money securities simultaneously. The second category is fundamental factor models. These models use firm characteristics such as price-to-earning ratio, book-to-price ratio, growth, or market capitalization. The Fama-French model is the most famous example in this group. The third category is statistical factor models. These models do not start with an economic theory. Instead, they use statistical techniques such as principal components analysis or PCA to extract common patterns from historical return data. After the factors are extracted, the analyst interprets their economic meaning. These concepts, of course, will be discussed in detail in a separate video. For the exam, if the question mentions PCA or factor extraction from covariance structure, the correct answer is statistical factor model. A multi-factor model requires several inputs. The general structure is given here. RI, return of asset I, is equal to expected RI or expected return plus B1 times factor 1 plus B2 times factor 2 plus all the way beta K times factor K. This compact form helps you see the building blocks of the model clearly. You need an expected return anchor ER, a set of chosen factors F, a beta or sensitivity for each factor, the realized or expected value of each factor term depending on the version of the model, and finally an error term for unexplained firm-specific return, sometimes called error term here. The most important quantity to interpret is the factor beta. A factor beta measures how strongly the asset responds to that specific factor. For example, if a stock has a GDP beta of 2, then a negative GDP surprises of 1% would imply roughly a negative 2% impact on the stock's return contribution from that factor alone. We give a numerical example of this model with detailed solutions in the exercise file associated with this video. A critical clarification is that factor beta do not have to be positive. They can be positive, negative, or 0. A negative beta means that the asset tends to move opposite to the factor. That can be extremely important in hedging applications and in exam questions involving sign interpretation. Now let's apply the framework numerically. We are told that for the healthcare INC, expected return is 10%, GDP beta is 2.0, expected GDP growth is 3.2%, and actual GDP growth is 2.6%. The first step is to compute the GDP surprise. That's actual GDP growth rate of 2.6% minus the expected GDP growth of 3.2%, which is equal to negative 0.6%, or in decimal term it is negative 0.006. That surprise is negative because actual GDP growth is lower than the expected GDP growth. Next, we plug the result into the single factor model, which is RHCI is equal to 0.10 plus 2.0 times negative 0.006, which is equal to 0.088 or 8.8%. Let's interpret this result. The stock has a positive GDP beta as shown here. So it benefits when GDP growth surprises on the upside and suffers when GDP growth surprises on the downside. Since the surprise here is negative, the factor contribution is also negative. Therefore, the model implied return falls below the baseline expected return of 10%. For the exam, always separate the problem into 3 steps. First, compute the factor surprise. Second, multiply by the beta. Third, add the result to the expected return anchor. And this sequencing avoids many common mistakes, especially during the exam. APT depends heavily on the idea of well-diversified portfolio. The reason is that diversification reduces idiosyncratic risk. When enough individual firm-specific noise is diversified away, the systematic factor structure becomes the dominant source of risk and return. This is why the theory applies most naturally to diversified portfolios rather than to every individual security in a perfectly exact way. APT does not require a perfect pricing relation for each single stock at every moment. Instead, it requires that arbitrage opportunities among diversified factor-equivalent portfolios should not persist. This also explains the role of correlation. Assets from different sectors or asset classes often have different and less correlated exposures, which makes diversification more effective. A broader portfolio is therefore a better environment for the APT framework to hold approximately. For the exam, if asked whether APT must hold exactly for every individual security, the careful and exam correct answer is no. The strongest statement applies to well-diversified portfolios. One of the most practical uses of multi-factor model is hedging. Once we estimate a portfolio's factor betas, we can try to offset unwanted systematic exposures. Suppose a portfolio has a large positive exposure to GDP growth. If the manager wants to reduce that exposure, the manager can take an offsetting position in another asset or derivative whose GDP beta is negative or whose position sign offsets the original beta. The same logic applies for inflation, interest rates, consumer sentiment, or any other modeled factor. If all relevant factor exposures are neutralized, the resulting position is a zero beta portfolio with respect to the modeled factors. If such a zero beta portfolio still offers a positive expected return and consistent with its factor exposures, that could indicate an arbitrage opportunity. But here is the important practical warning. Hedging one factor may create another exposure. That's why multi-factor hedging is more complex than single-factor hedging. Now consider the 3 portfolios shown in this table. Portfolio 1 has a GDP beta of 0.50 and a consumer sentiment beta of 0.30. Portfolio 2 has a GDP beta of 0.50 and an employment beta of 0.25. Portfolio 3 has a consumer sentiment beta of 0.30 and a manufacturing beta of 1.25. Suppose we go long position in portfolio 1 and short position in portfolio 2. Then the GDP exposure becomes as following. GDP beta equal to 0.50 minus 0.50, which is equal to 0. So GDP exposure is neutralized. However, the combined positions will have a consumer sentiment beta of 0.30 because portfolio 2 has no consumer sentiment exposure. In addition, because we are short portfolio 2, we introduce unemployment beta of minus 0.25. This example teaches an extremely important lesson. A hedge can remove one factor exposure while creating another. A hedge instrument is only clean if it isolates the specific factor you want to hedge. For FRM questions, always check factor exposures first. Only after confirming that exposures are matched or neutralized should you compare expected returns to infer whether an arbitrage opportunity exists. Multi-factor hedging is useful, but it is not perfect. There are several practical challenges associated with this type of hedging. The first is model risk. The chosen model may be incomplete or incorrect due to whatever reasons. If the relevant factors are omitted or if beta estimates are poor, the hedge will not work as intended. The second challenge is the rebalancing trade-off. If you rebalance your portfolio too infrequently, factor exposures drift and tracking error increases. In contrast, if you rebalance too frequently, transaction costs may become too high and destroy the economic value of the hedge. The third challenge is non-stationarity. That is, factor relationships may change over time. In this case, betas estimated from historical data may not remain stable, especially during crises or structural market shifts. The fourth challenge is implementation risk. Real hedge instruments may not be pure, markets may be illiquid, and non-linear payoffs such as those from options can complicate the exposures. For exam purposes, these 5 phrases should be easy to recall: model risk, implementation error, non-stationarity, trading costs, and tracking error. We now move to the most famous multi-factor model in empirical asset pricing, the Fama-French 3-factor model. This model extends capital asset pricing model by adding 2 more factors beyond the market factor. The expected return form is given by this relationship. In this formula, the expected return is a function of alpha here, which is abnormal return not explained by these 3 factors and can be manager scale if persistent, plus the market risk factor as defined by capital asset pricing model CAPM, plus the size factor, which is the difference between large cap return and small cap return, shown as SMB. Small firms are riskier than large firms, and therefore the expected return from them are on average higher. The third factor is in this model is the value effect, which is the difference between return of value stock and growth stocks. Value stocks are those whose book to market is high, and this is generally smaller but riskier firms. Growth stocks, on the other hand, are those whose book to market value is lower, which are more stable and less distressed, and therefore lower expected return. This factor is measured by HML, or book to value. And the regression form is given by this relationship, and in this form we have the error term or unexplained deviations at the end by epsilon p. Let's define the factors. The market factor is simply the usual market excess return. SMB A or small minus B, big is the return on small cap stocks minus the return on large cap stocks. So it captures the size effect. HML or high minus low is the return on high book to market stocks minus return on low book to market stocks. So it captures the value effect. Conceptually, this model says that asset returns are influenced not only by broader market exposure, but also by whether the asset behaves like a small cap or a large cap stock, and whether it behaves like a value stock or a growth stock. Now let's interpret the factor coefficient and then work through the numerical example. If a stock has a positive SMB loading, it behaves more like a small cap stock. If the SMB loading is negative, it behaves more like a large cap stock. If the stock has a positive HML loading, it behaves more like a value stock or even a distressed stock in some interpretations. If the HML loading is negative, it behaves more like a growth stock. Now, use the given data. Market beta is 0.85, SMB beta is 1.65, HML beta is negative 0.25, market risk premium is 8.5%, SMB premium is 2.5%, HML premium is 1.75%, risk-free rate is 2.75%, and substituting these values into the model, we get all the way 13.66%. Notice the sign on the HML term. Because the HML beta is negative here, that factor reduces expected return rather than increasing it. This is one of the most common calculation errors in FRM style questions. Always be very careful with the signs of each beta in the model. The Fama-French model did not stop at 3 factors. Later research extended the framework. The Carhart 4-factor model adds a momentum factor, often called MOM, which captures the return differences between past winners and past losers. The Fama-French 5-factor model adds 2 more factors, RMW, or robust minus weak, which captures profitability, and CMA, or conservative minus aggressive, which captures the effect of investment policy. These extensions show that empirical asset pricing kept moving toward richer multi-factor structures. But for the FRM exam, the core requirement is still the 3-factor model. You should know the expansions or the extensions conceptually, but your strongest focus should remain on SMB, HML, interpretation of loadings, and expected return calculations. Also note the subtle point mentioned in this slide. When the 5-factor model is used, HML may become less important or even partly redundant in some empirical settings. Now let's discuss alpha. In the Fama-French regression, alpha is the intercept term. More generally, alpha refers to return that is not explained by the factor model. If realized return exceeds what the model predicts, the difference may be called positive alpha. If realized return falls short of the model implied benchmark, that may be called negative alpha. However, you should be careful in interpreting alpha. Positive alpha does not automatically mean skill. It might reflect superior management, but it might also reflect omitted risk factors, temporarily mispricing, data noise, or model misspecification. This is an important FRM point because the exam may test whether you understand alpha as model relative abnormal return, not simply as proof of manager talent. Let's close the tutorial by bringing everything together. APT extends the logic of CAPM by allowing multiple systematic factors to determine expected return. Its strength is flexibility and richer risk decomposition. Its weakness is that factor selection and estimation are not dictated fully by theory, which creates model risk. For FRM exam success, focus on 4 pillars. First, know the equations. Second, interpret the meaning and sign of factor betas correctly. Third, understand how multi-factor hedging works and why it is imperfect. Fourth, master the Fama-French 3-factor models, including factor meaning and numerical calculation. And if you can move smoothly between intuition, formula interpretation, numerical calculation, and hedging logic, then you are in a very strong position for FRM questions on this topic. Thank you for following this tutorial, and please don't forget to work through the exercises related to this topic from the link given in the description. The exercises, of course, mimic the actual FRM exam and make you well prepared for the actual one. And the detailed solutions to each questions of this exercise is also given at the end of the same paper. So see you in our next video. Thank you very much.